You were just out at Washington University with all of the heritage of Murray Weidenbaum and all of the optimism of Washington University on growth. Can you be optimistic about the American economic experiment at this time?
Well, it depends which one, but the current one, the one we're all thinking about, is how we're going to basically decrease inflation and get back to a low level. And there, I'm not as optimistic as most people. I still think it's going to be very, very tough. I think inflation has a lot of momentum. I think wage growth is, it's a very tight labor market. Wage growth is very strong. The Fed is going to have a very hard time slowing down the machine, and it has to admit that it has to slow the machine a lot. And we don't want a recession, but there's this term called growth recession. I think that this will have to come with some increase in unemployment and maybe some increase in rates beyond what is currently priced in.
With all of your work, and particularly with the firepowered MIT in the 70s, you lived the dismal 70s and the debate over entrenched inflation. You have a chart at Peterson Institute of the 7 or 8 year battle to extract ourselves from 1975. Is that our future out to 2030?
No, it's the past. It's not the future, but it's a warning. Basically what happened is that the Fed just delayed doing what it had to do, and Paul Volcker came very late in the game and just went at it. But he had to increase rates by 1,300 basis points to actually get to where he wanted. We're not going to go there. The Fed is much smarter. Inflation expectations are not as bad. But, the hope that we can do all this by having rates going to 2.5 or even 3, I think is a hope, not in my book of forecast.
The hope is underscored by the mystery of some of the tools that the Fed is using, and I'm thinking most importantly of the Federal Reserve's balance sheet, possibly reducing it by $1.1 trillion over a year. How much do we understand how this reduces inflation?
Well, it's likely to make the long rates a bit higher than they would otherwise be. So to the extent that long rates affect activity, that's going to basically slow down again the machine. And that's the way you reduce inflation, is basically by making the labor market less tight than it is. Now, exactly how it works, I think when it comes to the policy rate, I think we have some understanding of how it affects the economy. When it comes to QE or QT now, I think we know much less. And if I were the Fed, I would denounce some path, but not feel that I'm committed to it if it turns out to be the stronger, weaker than expected.
Do you think we're heading into a period of time where inflation is structurally higher than it has been over the previous few decades because of deglobalization and because of some of the shifts that we've seen that were accelerated during the pandemic?
No, I don't think so. I don't think there's any close link, say, between productivity growth or globalization or any of these structural elements and the rate of inflation that the economy has. The rate of inflation can be anything. You just have to have it flat. You basically have to operate the economy at full employment, not hotter than that, not colder than that, but you can have any rate of inflation you want.
Olivier, you have lived the vogues and the religions of the moment. You and I remember where the world stopped. I believe it was on a Thursday afternoon at 3 p.m., and we'd all count M1, M2, M3. There's been any number of other religions of economics. What's the religion right now that we need to be aware of, that we need to fear?
Well, I was never kind of in the M1, M2, M3 religion. I always thought that was a religion and not science. I think the way to think about how monetary policy works is you look at the yield curve. And some of economic activity depends on the short end of the curve. Some of economic activity depends on the long end, say mortgage rates. And basically, the higher the yield curve, the more tightening there is. I think that, if I had to choose one object, as opposed to, say, M1 or M2 or whatever, I would say just look at the yield curve. And the yield curve, I think, is telling us rates are going to go up for a while. Then maybe they'll come down a bit, at least adjusted for inflation. And I think that's the tool that the Fed has. Now, in the old days, it only played, at the short end. Now it plays all the way through the yield curve, but that's the object I think we have to look at.
What's the tool of real yields, Olivier? And I talk about this as the real yields, the inflation-adjusted yield on 10-year treasuries moves to the highest, the least negative, I should say, going back to March of 2020.
Yes, I mean, you have to realize that we're still in an era of very, very low real rates. At the short end of the yield curve, real rates are very large negative. At the long end, they are less negative than they used to. I think they are getting closer to zero. I think that's what's needed to get the economy going in the long run. We don't exactly know what the long run equilibrium rate, if you want to call it this way, is, but it's probably around zero at this point. So if we were, cruising along with no more inflation than target, then I would say zero is probably the right number. But before we get there, we have to get inflation down. So we have to go above zero in terms of real rates.